You're listening to the Good Food CFO podcast, where we focus on financial strategies for building a profitable food business. I'm your host, Sarah Delavan. On today's episode, I am joined by Michael Movitz, founder of the Movitz Group and founding partner of Brandjectory, an online platform helping early-stage CPG founders and investors to connect, share information, and build momentum before, during, and after a capital raise. If you're a food business owner thinking about raising capital, if you are wondering which type of investment is right for you and your business, if you want to make sure that you are well prepared to meet potential investors, or if you simply want to educate yourself on the process, this episode is for you. Michael is sharing a ton of valuable information, and he's got a free download for us. I am so excited for you to listen in on our conversation, so let's get to it. Michael, welcome to the Good Food CFO podcast. I am so excited to have you here today.
Hi, Sarah. Thank you. Same here.
Amazing. So I'm really excited about our conversation today. I'm excited for our listeners. As I mentioned in the intro, you are the founder of the Movitz Group and co-founder of Brandjectory. And I would love for you to just share a little bit about the work that you do with business owners before we dive into today's conversation.
Sure. Well, the Movitz Group is an advisory working with early stage founders on go-to-market strategy and helping them to prepare to raise capital. So that means that we're working with founders to develop their business plan strategies, their commerce strategy, consumer strategy, pricing, product positioning, and category analytics with retail and e-commerce data, those kinds of things. And then on the Brandjectory side, essentially, actually, I forgot to mention one thing. With also on the Movitz Group, we're also helping them with their financial models and their investor pitch presentations. So essentially, helping them to develop their go-to-market strategy and their articulation of their proposition to investors. And then Brandjectory helps to expose them to best fit investors through the web platform.
Awesome. So when we're talking about the types of investment, the ways that businesses or founders can raise capital, can you just kind of lay the foundation for us and talk about the many ways that founders can do this?
Sure. Well, there's many different sources of capital, and I think that we tend to think about getting investors and having them buy parts of our company as the default. But the reality is that there's many different sources. So, of course, the first, as we probably are all familiar with, would be our own selves and what we like to refer to as bootstrapping. So, that's our own savings, our maybe a line of credit that we have, or mortgaging our house, or credit cards, which, can be very, very expensive. After we get past the self-funding, then we can look at bank financing and debt financing. So that can include bank loans that are underwritten by the Small Business Administration. There's things like peer-to-peer lending, like the Lending Club and Prosper. There's asset-based financing, or asset-based lending, which is where essentially you can use your POs or your inventory as collateral and get a loan based on a portion of those assets. There's micro lenders. There are community development finance institutions. There's crowdfunding that can work from a debt standpoint or just a gift standpoint. So there's many ways to source additional capital before you have to go to the investor side. And then when it's time to get to equity, equity is essentially, or investment from somebody, that's essentially, giving up part of your company to have somebody give you some money, and their expectation is that they're going to get a, large return for their investment. And so there's typically family offices, angel investors, high net worth individuals that are doing private investments. Friends and family can be another place, actually, that would precede institutional capital. And sometimes friends and family can also be a source for debt financing instead of just investment financing. So just, there's a few there, and there's, crowdfunding. You can also give away equity, and so there's different sources of investment and capital raising. And I think it's important too to think about, what is your capital strategy and what's going to be the best fit for you. Because one of the things of taking somebody else's money is you are now accountable to somebody else, and you're essentially getting married to them because you have their money and they have expectations, you have obligations. So it creates a different dynamic between yourself and the lender or the financier.
Yeah. You said, kind of jotted down really quickly, before you have to go to equity. So there are these other ways of sort of raising capital or funding a business. Do you think that business owners, and you may not be able to answer this question because I realize I'm sort of asking it in a blanket kind of sense, but do you think it's wise for most founders and business owners to consider other methods of funding and raising capital before they go to equity investors?
I do if it's the right fit for the situation and the people involved. So, with
Okay.
an investor, there's a couple of different types of people that could be your investors. You could have passive investments or active investments. And passive would be where somebody writes a check and you are off and running with whatever your plans were, and now you've got the fuel, to do that. An active investor is going to bring a lot more capabilities to the table. Maybe they have a network. Maybe they have expertise in the space. Maybe they have been in the category before, have run that type of company before, and they can contribute a lot of wisdom and experience to your process and to your growth, and that can be incredibly valuable. So it really is a matter of where are your strengths and where do you need some help, and seeking out sources of capital can be a good place to fill some of those gaps. There's one other capital source that could be considered, and that's grants. There are, FedEx has a grant program for small businesses. The National Association for Self-Employed has a business grant program. And so there's a variety of others that are out there that could be an option that have no strings attached from an obligation standpoint. You've made your point, and you've demonstrated the value that you bring, and so somebody's willing to grant you money to do that.
Yeah, I love that you mentioned that. A lot of our listeners are females, women. So we've got, women founders listening today, and there's a really great organization called I Fund Women. That's an
Yes.
amazing resource for grants and other types of sort of funding options, if you will. So I'm really glad that you pointed out grants as well. And I want to go back to the point you just made about thinking about where are your strengths, maybe where do you need support in your business, but even bigger than that, just why are you raising capital, right? Like, I think a lot of business owners that I talk to, they think, well, I need to invest in inventory, or I just, wish I had some more cash flow in the business. And that is driving this idea or the desire to seek funding of some type. But I think I'm just kind of latching on to this idea of really getting clear on really what your vision is for the business and what your goals are, both for the capital that you are bringing on, and what you're going to do with that money. And it also seems like what type of relationship or non-relationship you want to have with the source of those funds.
Yeah, that's an excellent question. There's two primary reasons why somebody would need cash, and typically it's because they either need to grow, and they have a plan for growth that they can't fund through their own through the existing revenue, or they've just gotten some big wins and they've got the POs and they need to produce the inventory so they could ship it to the store or to the customer, and the cash is not on hand.
Yeah.
So both of those are great reasons to bring in additional sources of capital. And whether you're cash flow positive or not, those are going to be the primary reasons, and good practical reasons at that.
Awesome.
One thing I'll mention too is that, at least from an outside investor standpoint, investors want to invest in a company for growth, not to repay old loans. And so if there are past debt burdens that are kind of overhanging, that's going to be a little bit tougher of a situation to work through than if it wasn't there, or that you didn't have the immediate obligation to have to pay those back.
Yeah. I love that you took the step in our conversation to what investors are looking for, because I want today's conversation to really center around thinking about seeking investor or equity capital. So those businesses, the founders, business owners that are listening today who have been thinking about this, who maybe are like, yep, I fall into one or both of those, primary reasons that seeking capital, is a good idea, or why they might need to do it. And I want people to really, at the end of our conversation, have clarity on sort of what they need to be thinking about, the work that they need to do before they go to seek investment and to start reaching out to investors. And maybe you can talk a little bit more about, what do investors look for, or what type of information are they seeking from a founder who may be in this stage of their business?
Okay. There's three really big parts to answer that question.
Okay.
The first part is, on a macro level, what are the investor objectives? And first and foremost, there's four primary. The first one is to mitigate risk. An investor is looking for reasons to say no, because they have lots of places they could put their money, and they have lots of opportunities to earn a return. And so they are looking for a reason to put their money in the best opportunity. And so the objective of a founder is to overcome all of those objections about why their investment is not as risky, or why the objection is, the risk involved. And so the investor is looking to mitigate that risk, and so a founder has to address that. The second objective an investor has, as I mentioned, if they're looking for growth, that means that they want to scale the business. They want it to become something. And so there is a little dynamic to the investor-founder relationship that is crucial about compatibility, that your visions and objectives are aligned. If the founder wants to create a $10 or $20 million business and hand it off to their next of kin, but the investor wants to blow it out to $100 million in 5 years, well, those are very different objectives, and that's probably not a well-aligned relationship. The third thing is that an investor, of course, wants to achieve a certain return in a certain amount of time. And so that, typically they're looking for, an angel investor is looking for 10x of their investment in, call it 3 to 10 years. Average angel return is typically in about 10 years, although they try to get it sooner. Most of the time it takes that 10 years. And then lastly, the investor is looking for an impact objective, if it's relevant to their thesis and to their position. So that means they want to invest in a mission-based business that's all about social or environmental or sustainable impact. And so they want to not just have a financial return, but to see that benefit in some of those other metrics. That's the first part.
That's so helpful. I am not an expert in this area. And so I'm so excited to be having this conversation with you, not only for my listeners, but also for my own education. And I have to say that even just getting clear on what investors are looking for, what they're going to be thinking about as they learn about your business and as they look at some of the information that we're going to talk about next. It's extremely helpful to have this very clear, concise information about what investors are looking for. So thank you so much for laying that groundwork for us. That's really amazing.
You're welcome.
And I know that you have sort of I'll call it a list of 10 foundational items, we'll call them, that founders should have prepared, put together, thought through, and available for potential investors. So now that we've got sort of an idea of these 4 things that investors are looking for, can you talk about these 10 foundational items, and business owners listening out there, get your pen and paper ready. But if you're driving or walking or doing the dishes like I do when I'm listening to podcasts, we're also going to have this list of 10 foundational items available for download. So you can check out the show notes and download this list. But let's talk through them right now, Michael.
Sure. Well, and this is the second part to your big question, which is, what type of foundational things need to be in place before we can talk about what are the investor expectations and what's their criteria, I should say. So as you said, there's 10 things that myself and my co-founders at Brandjectory have identified as the fundamental foundations that a founder should have in place before they start seeking capital from an outside investor. And the reason why these are so important is because an investor needs to see these all in place before they are ready to give consideration to a business. So let's start with the team. Having a team in place is at an early stage is the game, because when a company doesn't have a lot of revenue or a lot of traction or a lot of consumers, the angel investor and the early stage investor is betting on the founder. And so if the founder has expertise in the industry, expertise in the category, experience in the business, that's a big plus. So, but if not, then that's not always the case, then it's the people that the founder surrounds themselves with is the next best thing. So that could be a co-founder. It could be, if they're at the point of an employee, that's fine. Otherwise, it's advisors, it's consultants, it's board members, whoever the founder can seek that guidance and wisdom from to help them navigate the waters of that early stage company. It's going to be really important to demonstrating that credibility and to building that credibility with the investor. The second thing is a business plan. And I'm not talking about a 100-page plan that nobody ever reads. I'm talking about being very clear, even if it's a couple of pages, or there's even the lean business plan model, which is a 1-pager. It's being very clear on what business are you in, how are you going to operate it, how are you going to make money, how are you going to market, how are you going to sell it, and who are your customers, and what's your differentiation, and why are you better? Why should consumers give you their money and trust you? That's what a business plan needs to be. And so without that in place, it's likely that the founder may not have a clear articulation of how to speak to that investor to convince the investor that there's a winning business there. Operations need to be in place. And so what this means is that you need to have a reliable source of ingredients, a reliable manufacturing process, and backups to both of these. So you don't need to be working with 2 or 3 different suppliers or manufacturers. That would actually not make a lot of sense in the beginning. But you need to have backups so that if there's a disruption in one, you've got the option to continue your operations without too much of a hiccup. The next thing is regulatory compliance. So if it's food and beverage, this generally is around labeling, but maybe there's an ingredient that needs to have some special consideration. If it's a supplement or personal care, there's a lot more regulation around use and claims around those types of things. But if the company is vulnerable from doing something that's not compliant, an investor is probably not going to want to talk to you until you are compliant. This one seems a little obvious, but there needs to be a market need, and it needs to be a meaningful need. So, solving a problem that an individual has that's not a really big problem is not going to fit that investor criteria of being able to scale the business and make an impact. So, and how do you know what that need is? You have to be able to quantify it in dollars, quantify it in consumer, quantify it in share of something, share of stomach, share of something in the marketplace. But it's got to be quantifiable. And I would also want to caveat that by saying that it's not just, let's say you've got a snack product. Snacks is a $100 billion segment, but an individual, a founder's opportunity is not $100 billion because that's all snacks. The type of product that a company might have might make and the type of consumer that it's positioned to might make its addressable market 3 billion, 5 billion, 10 billion, but it's some subset of that total. And so knowing what that total addressable market is really important.
Can I ask a question here?
Sure.
For those folks listening who are thinking to themselves right now, how am I going to figure that out? How do you predict that? Do you have any advice, words of wisdom, a direction that you can point them in?
There's a ton of free information out in the press. Doing some web searches, particularly around industry-specific trade journals or other sources, whether it's from social media, and I don't mean just random people. I mean credible journalistic sources or research companies will oftentimes post a lot of typically top line or summary data. Whether it's in articles or in white papers or other studies that are out there, there's definitely a lot to be had with a little bit of research on the web.
And if someone is, because I run into this a lot, people are creating new products, products that have never existed on the shelves in U.S. markets, or even have never been available online. They're trying to figure out on their own, initially, am I a supplement or am I a seasoning? Am I a snack or am I a nutrient dense, health food? So just a follow-up question for someone who, you definitely have to get clear on where you fall. I know that would be like step number one, right? But do you simply can then rely on the information and the data for that particular category to start pulling this market need information together? Is that correct?
Well, you've hit on something that's probably one of the funnest parts of our jobs, right? Because we're in an industry where that kind of innovation is core to the daily activities. So you're absolutely right. You've got to be very clear on what your proposition and articulation of that is. But if it's something that's new or that doesn't quite fit into something traditional, then you just talk about the intersection of a couple of different segments out on the market. And if you can think about it from a Venn diagram or concentric circles or overlapping circles type of a thing, and you're blazing a trail.
I love that. Thank you. All right, back to the list. Number 6. What do you have for us?
Number 6 is probably one of the most important of all of these, from my humble opinion, and that is taste, efficacy, or valid science. We all tend to be overly optimistic as founders and fall in love with our own product, but it's up to the consumers to decide. And so if we have a product that the science is questionable, it doesn't work, it's not efficacious, or the taste is nothing special, we'll get trial, but we won't get repeat purchases. And the buzz out there on reviews or social media will not be complimentary enough to help drive the business. So I can't emphasize this enough, is that if you've got to get one thing absolutely right, it's got to be taste, efficacy, and science validity. Now, that doesn't mean that you have to be paralyzed by perfection. That's really important. But it can't taste bad. Right. It can't do nothing. If it's supposed to moisturize your skin and it's creating a rash, well, you can't work that out with the consumer, right?
Love that. Yep. So I imagine it's not uncommon for potential investors to sample the product. And, if I was investing in a food or beverage business, I would want to really love the product. So I imagine that's
Yep.
an important part of this as well.
Absolutely. And of course, everybody has different taste profiles and different preferences. And so, a lot of times when products are targeted to a certain, we'll call it a healthier lifestyle segment, um, those folks tend to have those consumers tend to have a little bit more tolerance from a taste preference
Yeah.
or willingness than the general market. And so that's okay. If your core consumer loves the product, but it's not for everybody, that's okay because you've got to start somewhere. You have to start with your the people that are going to evangelize for you. And if they love it, go.
Awesome.
Number 7.
Sounds good.
Number 7 is about the consumer value proposition, or what I would say is a brand. And so this is where you tell your story and describe who you are and what you are and why you exist and the value that you bring and the problem that you solve from a consumer standpoint. And when you look at reviews and social media posts and other things that are out in the market from consumers, they're reflecting back what you are describing your product as. So it's really important that there's alignment between how a consumer is using your product and what they think of your product and you as a brand and what you're saying you are. And if those are aligned, then you're going forward. But if there's some mismatch, then there's probably some tweaking that needs to happen. And so an investor will want to make sure that those tweaks are done. Now, granted, there's always iterations as companies grow, and the more consumers you get, the more market traction you get, the more you learn, the more you iterate. I mean, that's totally fine. But from the starting standpoint, if you've got a real mismatch from the get-go, that will be a deterrent for an investor. And for the business viabilities, for that matter, too.
Yeah, and I'm just thinking about a previous episode with Ali Ball, where she mentioned, a business owner who is an amazing cocktail maker and, used his shrubs to make alcoholic beverages. And that's really where he believed that his product was used most often and why people were buying it. But what was really happening was people were using it for a non-alcoholic use. They were using it for NA beverages. They were using it for salad dressings and things like that. So just want to lay that example out to kind of remind people that's sort of what a misalignment might look like, for example, and just really getting clear on what that is a great piece of advice. I love that.
Yeah, that's a great example too. And so there's a situation where the founder has two options. They can either adjust their messaging or go with what the consumers are pulling, right? Instead of trying to push, pull.
Love that.
The next item is that the investor wants to know that there's some metrics that are known by the brand. So whether that's e-commerce or retail movement, velocity, some traction, basically validation. So there are some angel investors and early stage investors who will invest what we'll call pre-revenue or zero or close to zero. In those cases, there effectively is not any market validation. But once you get into 6 figures, you're starting to get that market validation and some clarity from all of the other propositions that we talked about. But you also start to get some metrics on movement and velocity and repeat purchases and cost of acquisition and, also comparison to others in the category, either competitive products or category averages. And that's really important too at this point, is to understand how high is up and exactly what defines good. Mm-hmm. In the beverage category, going through 12 to 24 units a week is probably about the benchmark that a lot of retailers would use. That's 24 units per SKU per week per store. That's what some retailers will use as their benchmark. If you're not meeting that threshold, then you're at risk of being discontinued. But in another category, it might be 3 units a month. So it totally depends. And knowing where you stand versus those benchmarks is crucial, because it gives both yourself and the investor a reference point for how well are you doing, or how much work and how much work do you need to do, to get up to snuff, so to speak. And and by the way, a startup is never going to have, almost never going to have, be at those benchmarks, right out of the gate. It's just not possible unless you've got, the unicorn. But otherwise, so you build up to those, and what's important is that you know where you're building to.
I love that. I was going to ask the question sort of like, this isn't something that happens overnight. This seems like something that I would think is tracked over time, right? How are things going, right? What's our next benchmark that we as a business are striving for? And almost keeping track of that. So perhaps if you're not at the benchmark yet, you could still show a potential investor, this is the progress we're making. This is the efficiency at which we're doing it. And so that gives you some clout, if you will.
100%. And by the way, on the, to use your earlier question about how do you find those benchmarks, at the earliest stages, there's free information available from brokers, from distributors, from, retail buyers will sometimes, verbally provide that. But, just ask. No need to invest, lots of money at this early of a stage, for that kind of data.
Love that advice. I totally agree.
Next one is budget and bookkeeping. So having a budget is really important because that shows that you have put some forethought into your planning, and you have some idea of what it's going to, where you want to go from a growth standpoint, but also what you're going to spend to support that growth. And then related to that is bookkeeping practices. You are hopefully out of Excel for tracking your financials, and you're working with QuickBooks or FreshBooks, and you're also classifying things as GAAP compliant. So the investor has confidence that things that are quote unquote above the line and below the line are properly classified. And I'm sure, Sarah, that you've got a lot to say on that topic.
I'm just shaking my head and smiling over here, thinking about how this is, on the list so far, the metrics get me. I really like that part, but budget and bookkeeping, anyone who's listened to the episodes up until this point knows how I feel about this, right? And I think number one for me is knowing what goes above the line and what goes below the line, getting clarity on that. Number two is looking at the financial information that's going to help you as a business owner or founder run your business, right? Mm-hmm. And then once you've got that information laid out in your finances, then you can not only create a budget that is realistic and valuable as well, but you can start getting to work on what I call financial efficiency, which is something that I imagine a potential investor will want to see. If you are spending money in your business, what is that money producing, right? How efficiently are we able to turn revenue into profit? And so number 9 is like my sweet spot on this list. So I'm quite excited about it. And I believe in the importance of this, whether you're looking for investment right now or in the future, or if you don't ever plan on seeking, funding. I think this is an important piece for any business owner.
We should have left this for number 10. Go out with a bang.
It's all right. What is our number 10?
Number 10 is not actually related. It's a pro forma based on a 3-year projection. So pro forma means that it's a projected growth and expenses, and depending on the size of the company, it could be either a 3-year or a 5-year. Typically, this is monthly growth and monthly expenses projected out for, like I said, let's call it 3 years for an early stage company. Mm-hmm. At a minimum, it should be annual. Hopefully, you've got monthly numbers to understand what's going to be changing month to month, because an annual number is really hard to manage against.
Yeah.
It's okay on a backwards-looking basis, but on a forward-looking basis, unless it's way out into the future, your near-in time periods really need to be on a monthly basis. But the pro forma basically is not just the numbers that tell the investor what's the outcome of your planning, but the pro forma is where your assumptions about the business lie. And it is the assumptions themselves that are the difference between building a viable business and not building a viable business, because you can project all kinds of growth and efficient spends to get that growth. But if it's not realistic, if it's not practical, if it's going to turn the investor off right away. Not to mention that put your business at risk. That if you don't have a well-informed and well thought through, strong assumption-based plan and pro forma, you're putting yourself in a behind the eight ball right off the bat.
Yeah, I've met with some business owners who have pro formas because they either sought investment in the past or they're thinking about it for the future. And in a few cases, it has been, just astronomical growth that has been projected. And the reality has been that they were nowhere near those numbers. And it's kind of surprising to me. And I'm not trying to speak negatively of anybody, but just the fact that we've seen on a few cases in our business, just these amazing growth numbers that seem impossible for someone to reach, but that information is going out to potential investors. And so I wonder, I don't even know if I have a question about that. It's just more of an observation that I think is concerning for me. I come from a place of a slightly more conservative projection. I would rather maybe under promise and over deliver, right? And set my business owner up for success rather than say, this is going to be amazing and we're going to, sales are going to go crazy and we're all going to make bazillions of dollars. I don't know if you have anything to add to that, but I guess what I'm trying to say is I that makes me nervous, and I like a little bit more of a realistic pro forma. Any thoughts on that?
Yeah, I would concur, and there's some colleagues of mine have what they call the hockey stick Hall of Fame, where year one is 50,000, year two is $1 million, and year three is 15 million.
Wow.
In sales, and so certainly there's the human nature to be irrationally exuberant on what we can achieve. Mm-hmm. But I think that those plans that exist like that just tend to be, there's not enough information that's been put, or thought and information inputs that's been put into the development of those plans. Because if certainly high growth is possible, but it costs a ton of money to get it. And it also requires a tremendous amount of know-how, experience, and people to make that happen. So I'm definitely in the camp of being reasonable and practical, as are the overwhelming majority of investors.
Yeah. I'm just thinking in my mind, to make a big leap in sales, where my mind immediately goes to is, getting the operations set up to support that, having the team in place to support that. So, just remembering it's not about how many units you can sell. You have to produce those units. You've got to have, either that manufacturing partner and that ingredient sourcing partners. All of these pieces really need to work together. And I think a really wonderful thing that comes out of this list of 10 foundational items that you want to pull together if you're seeking investment, I think is just looking at the full picture of your business. And I think this is valuable for all founders and all business owners to do, and to think through, because I think there's a lot of clarity that comes with this work. So I really appreciate you sharing this within the framework of our conversation, but just in general, I think it's hugely valuable for folks.
Thank you. Yeah, you're welcome. There's certainly more, once we get past this foundation, the next stage is what kind of things do we talk to investors about? And then there's, how do we ensure compatibility between investors and founders, and all kinds of elements of the transaction itself.
Yeah.
So there's certainly a lot more to it, but in order to get to those stages, this foundation really needs to be buttoned up.
Is there, I know that there are some founders who are quite eager for investment because, as you mentioned, they've got POs that have come in and they need to now produce them, right? So there's a sense of urgency there, or the need to grow and have capital to do that. So I think it's a couple questions on that. Number one is, I always am telling people to slow down, to take their time, and to be really thoughtful and approach these things. So I assume it doesn't take a week or even possibly a month to pull together these 10 foundational items. Can you give our listeners a sense of, maybe how much time can go into really pulling this information together in a concrete way?
Well, it depends on the stage that some of these elements are in. So, for example, if the bookkeeping and budgeting is not in the right place, then that's an initiative in and of itself that could take several months to convert. Regulatory compliance, could take a while if that's necessary. A business plan, shouldn't be done over a weekend, but if you can get somebody to help, maybe a few weeks you can pull something together if you know how to speak to it. If you have any taste or efficacy issues with the product, that could take a while to rectify. So I suppose that if all of these things were in place and somebody felt good about the condition and state of all of them, I think a few weeks to a couple of months, would be sufficient time to properly present or compile and present them. But if something's not quite in sync, then you got to invest the time to make it right.
Yeah. And that's kind of the answer I was I was expecting you to have, is just to say that, these aren't things that you can do very quickly, right? We want to do this right, and they're all going to take time. And I'll be very open and honest and say that there are clients that I work with where the bookkeeping is really, it's always the first thing that we have to tackle. If we don't have any, prior financial information to work with, then we've got to model, right? And we've got to set up the bookkeeping, and we really have to get that foundation in place. And depending on how much time someone has to spend on that work with me, right, it could take several weeks, several months to get that set up. And then I would say too, just from the budgeting perspective, you can have a budget, but I think part of the work is that you don't just create it and say it's done. Is you create it and you work that budget and you say, how realistic is this? Are we achieving the outcomes that we believe that we are, and sort of tweak that. So it was a tough question that I just threw at you, but what I was trying to get at was that this takes time, and each step in this process is a small process in and of itself. So makes perfect sense. On a similar topic of eagerness, on the part of the founder or the business owner, when they're ready to get things going and moving, you offer some advice on sort of taking your time and making sure that you're choosing the right investor, right? It's in some cases the right partner, depending on the type of investment that you're seeking. Can you talk a little bit about what that process looks like, and also how Brandjectory can help founders with this process? Because I think it's really interesting what you are doing on that platform.
Yeah, great question. So when we talk about compatibility with investors and founders, we're going to skip over a huge part, which is, what are the investor criteria? What are they looking for? What do they need to hear? All those kinds of things. And we could go on for a long session about that. So I want to start the answer to your question about the eagerness element with working with an investor is based on a relationship. And so a relationship needs to occur to build trust, credibility, comfort, confidence in both parties. It's not a one-way street. Working with an investor is a partner. And if you don't feel like they're a partner, it's probably not the right relationship, and they're probably not the right investor. So that's first and foremost. And so to build that relationship, First of all, there's studies that say that it takes at least 25 to 30 interactions with the same investor to get to a transaction.
Wow.
And that's indicative of the fact that it takes time. There's a process. There's things that you need to learn about each other and process and feel good about each other to be able to move yourself towards that ultimate consummation, as it were. So that's the first thing. So then we talk about, okay, so who should we be talking to? Well, the first and foremost is there needs to be alignment between investors and the stage that the investors invest in and the stage that the company is in. So if I'm a startup company and I've got $50,000 or $150,000 in sales, I'm probably going to be raising a couple $100,000, maybe a $500,000 on the outside. I'm not going to be raising $5 million right now because that's just not appropriate for the stage that I'm in. So an investor who writes checks for $2 million and above is not the right person for me to be talking to today for me to get my investment today. However, it is crucial to build relationships with every investor no matter where they invest, because an investor you meet today could be your investor tomorrow when you reach their threshold and their milestones for investment. And so maintaining that connection and that contact is really important. And that's actually one of the key things that we built Brandjectory for, is for brands and investors to discover each other regardless of the stage. And then if both parties are a fit for each other we'll call it the current time, then perhaps there's a transaction that can occur. But if the investor is later stage and the brand is early stage, the platform provides an opportunity for the brand to tell its story over time as the brand grows, so the investor can learn about the company over time and learn the whole story, see what the trajectory of the brand is on, gain confidence in the brand's business viability. Over time, one day we'll be meeting back together again in live settings, but even now virtually or on the phone, having occasional check-in meetings with investors who might be current or later stage opportunities for investment. Brandjectory gives those investors the opportunity to say, oh, when I met with her in the meeting on such and such, she said that these were the things that were going to be happening with the company, and I see based on the posts of their accomplishments on Brandjectory, those things are happening. As an investor, I'm going to gain confidence in that founder's ability then to manage the money that I may invest with them, because they're getting it done with what she said that she was going to do. Brandjectory itself, beyond the discovery and the connection element between brands and investors, it's also an opportunity and a platform for founders to become capital ready. We provide a lot of guidance and support to help the founders know what an investor is looking to hear and how to speak to an investor, because talking to an investor is different from talking to a consumer or from the trade. We have social media for brands to talk to its consumers. We have trade shows and RangeMe for a brand to talk to its retail buyers and others in the trade. And Brandjectory is that platform and venue for a brand to be able to talk to an investor in a language that is meaningful and resonates for the investor. Things about the business model, how is the business going to help the investor achieve its goals, which are very different from how the consumer achieves their goals.
I love it. I think one of my questions is going to be, when is the right time for a brand to, join Brandjectory or start thinking about that. But it seems like, even from a young, from an early stage, as you've put it a few times, it can be a good place to find support and assistance to become capital ready, as you said. And I love the idea of connecting potential future investors to founders in a way that allows you to sort of, it's almost like courtship, right? You can kind of learn about one another, so kind of sort of see how the brand is growing, but also how the founder or founders are growing in terms of their capital readiness and how they're reporting and what kind of communicators they would be, and all of that stuff that seems extremely important to both members of the process. And probably from the founder perspective, you get a little glimpse of how the potential investor would be communicating or, supporting you. And I just think it's such a great idea. And as someone who's sort of outside of that world, even though I'm involved in food business finance, it's much more on the operational side of things. I think it's what you've told us today and what you've helped us learn is extremely helpful. And I think Brandjectory is just going to be an amazing resource for a lot of founders. So congratulations on getting the platform up and running. And thank you so much again for joining us today.
Thank you, Sarah. I hope this was valuable, and it's been great talking with you.
I think it was extremely valuable. I had such a blast talking with you as well. And just one more reminder that Michael's list of the 10 foundational items to have in place to become capital ready, we're going to have that available for download via the show notes. And Michael, before we officially sign off, where can folks find you on social media, your website? Give us all that good info.
I am on LinkedIn. The Movitz Group is movitzgroup.com, and Brandjectory is brandjectorynow.com.
Awesome. We'll have that information in the show notes as well. Thank you all so much for listening today. We'll see you next week. If you've been enjoying the Good Food CFO podcast, please consider subscribing, rating, and reviewing the show on your favorite podcast platform. It's the #1 way that you can support the podcast and help other food business owners find the show. We'll be back again on Monday with another brand new episode. I'll talk to you again soon.